Hey guys, welcome back to the Capital Mindset Show. Today we're going to be talking about the new addition to the portfolio that many of you have been asking me about, and that is Global Payments. So there you go. There's the name of the company. Now, if you want to figure out why it is I'm buying this company or why it is I bought this company, stick around, okay? So this will go to kind of set the record straight on this company. I want to actually showcase what you guys were probably seeing. So in the portfolio, you probably saw, and I definitely a lot of people saw GPN. It's line item 15, company number 11, and it is at 7.8%, sitting at about 5.02% unrealized gains. So why is it so strange? Because I acquired so much of it in such a little amount of time. Okay, so because a 7% addition, it seems a lot, right? And I want to give some further context. So I had some money coming in, and I'm also getting more aggressive as terms of acquiring companies now, right? We went through the liquidity crunch, we went through all that jazz, and I was talking about that for a long time now. Now we're kind of transitioning over. I'm starting to get more aggressive in terms of acquiring companies or acquiring shares of companies. And we're also, I already talked about this on the live streams, but we're also looking to buy or acquire some real estate. So looking to add that to our portfolio. So a lot of exciting stuff coming on. And with that being said, I think that now that the YouTube crowd is kind of catching on to the liquidity crunch, they're calling it the liquidity crisis, kind of the same thing. I think that's kind of indicative that we're definitely not in the beginning stages anymore. We're definitely towards the mid to tail end of this thing. And based on that, right, that's sentiment, by the way. I'm just kind of tasting the sentiment. It's makes me more comfortable with actually being more aggressive. So I'm kind of actually doing that with my money right now. And everyone is willing to do or can do whatever they want with their money. I'm just doing whatever I want with my money. Okay, so with that being said, I also want to give us the backdrop of the share price. So the share price is actually down 33.76% over the 1 year. Over year to date, yeah, it's down about 9.47%. So it's actually doesn't perform that poorly in the year to date scenario. But let's take a look at that 5 year. So you can see that they went to a high of almost 216 bucks, and that's about a 40% drop from there. I want you guys to pay attention to that PE ratio right there. So I'll actually move myself right there. So PE ratio about 36.72. Keep in mind that we'll kind of get back to this, but it's going to be important to remember that. All right, with that being said, I also want to kind of show you guys a little bit about this graphic so we can kind of get an idea of what this company does. So we're going to ignore the ISOs. Throw those guys away for now. We're going to talk maybe about the issuers, the gateways, the acquirers, and the credit card associations. Credit card associations, we have videos on those, or we have videos on Visa and MasterCard. We have videos on American Express and Discover. Discover and American Express, they are also issuers, so keep that in mind. They actually don't have Discover listed over there. Shame. But issuers carry credit risk. That's what I want you to remember. So from this video, I might build upon later down the line with other videos because issuers carry the credit risk. So this information will always be good, okay? Issuers carry the credit risk, acquirers do not, credit card associations do not, and gateways do not. Gateways include PayPal, Square, and all those guys. Okay, so those guys on that side, they are, we're going to talk about them separately. But PayPal, I got to tell you, because that's the company that I was assigned actually to do a lot of research in. I'm starting to like PayPal more and more and more. I know that there are plenty of videos, or not plenty, but there's several videos on the channel on PayPal, which, by the way, if you want to know where all these videos can be found, in the description, there is the content library. You press Control F or Command F, depending on your computer that you're using, whether it's iOS or Windows, and you can type in the ticker symbol, and it's not case sensitive, and you can find all the videos that are labeled, and they're labeled by date. So it actually makes it very easy. It's a very well-received thing, I think, so enjoy that. And then so we're going to focus on the acquirers. Notice that Bank of America, Citi, Chase, they have acquiring businesses as well. Okay, so that's something to note. Also, Fiserv and First Data are now one company, so those should be actually one. But that's not the point, right? Now I want to actually show you a little graphic that I think will make it quite easy to understand the flow of money. So this graphic, I think, is really easy to kind of use to explain. So we have the issuing bank, right? That's Bank of America. You're the customer. You get the credit card from Bank of America. They issue the card to you. They're the issuing bank. Get it? And then you go and spend that money at a merchant. So you have the online store. You do that. They contact the payment gateway. The payment gateway responds back. And then the payment gateway is kind of the intermediary with the acquiring bank. Remember the acquiring bank. And then the acquiring bank is the intermediary between the credit card network and the payment gateway and the store. And then the credit card network, Visa, MasterCard, they go through the approval process. It's basically, they're the plumbing. Think of them as the plumbing of the system. They're the rails of the system, actually. That's more the term that's used. And the payment is approved. The merchant gets the funding. Who has the credit risk in all of this? The issuing bank, and that is it. The payment gateway does not, the acquiring bank does not, the credit network does not, okay? Simple. The merchant does not either. So as soon as the merchant gets you give them the product, then you get the money. Boom, done. And then this business model has existed for quite some time. Of course, some of these players are new with modern technology. It's been more efficient. But back in the day of the Italian banks, back when you remember the Medici Bank, merchants would actually engage in long travel deals, right? And so the bank itself would actually, let's say, you were going to go to city X and you were going to make 1,000 gold, whatever. And the bank would say, I'll give you 800 now, and then I'll take the 1,000. So they take the risk that, the merchant gets robbed or whatever, and that 20% delta is their risk profile, all right? So that's what they'll take as their profit. And then if you make enough of those deals, and as long as those deals go through well enough, you make a lot of money, okay? So that was similar to what's going on now. It's a lot more efficient. You don't have to worry about highway robbery in this case. So obviously the risk profile is a lot less, and the percentage gain is a lot less, okay? So it can vary in terms of percentages, but it's not going to be 20%. All right, so with that being said, let's actually move over to some of the slide decks from the business. So all in all, they did grow about 8%, 9% on a constant currency basis. What I want to highlight from this, operating margins are also increasing, by the way. What I want to highlight from this that's actually fascinating is that they did exit Russia, right? So they left Russia and they were still able to grow. Very exciting there. Well, not exciting, but very impressive there, because they're completely destroying an entire country's business, right? Their business in an entire country, and they're still able to grow. Now, the most important part of their business is this one, the merchant solutions. And the merchant solutions makes up the most of the pie. So how do I know it's the most important? We'll take a look at the total revenue for the quarter, 1.95 billion. Well, the merchant solutions is 1.34 billion. Okay, so it's clearly more than half. And it's actually up the most, right? About 16% on a neutral basis, 17.3% on a constant currency basis, okay? So this is the one that we want to pay attention to the most, and it's in fact the one that's growing nicely. Now, this one did not grow as much. This one actually only grew 1% or 1.4% on a constant currency basis. This is the issuer solutions. So merchant solutions is the most important piece of the pie. Issuer solutions is a smaller piece of the pie, although we do like to see some growth there. Now, adjusted margins actually declined here by about 60 basis points, so we want to keep an eye out on that. Now, the outlook, though, is an increase of about 125 basis points, so we want to, again, keep an eye out on that for management to actually succeed on that. And they do say mid-single digits growth, so they do are expecting acceleration of growth, okay? Because we are in the low single digits. They expect mid-single digits, so I'm thinking 5, 6, 7, and 4, around there. All right, so on a total, we do see on an outlook a 9 to 10% growth in revenue, but 16 to 19% growth in EPS, as they can achieve some synergies from the acquisitions that they've been doing. So this company has been known to be a serial acquirer. It should be noted that this is actually what we're looking at. I took a look at some of the acquisitions they did. I approve of some of those acquisitions. I think most of them I think the management is doing a good job, I think. Okay, so that's personally my opinion. But we're kind of going to go over some of the technology stuff. There are some other aspects that I want to cover. So just a quick thing before I forget to say this, because I know someone's going to say, well, you didn't mention this. I just want to mention it. It's not the reason for the investment, but if I forget to mention it again, people are going to be like, you didn't mention it. This is an investment by Michael Burry as well. And so, yeah, there, I mentioned it. But again, we're going to stick to why it is that this actually might be a good business. I just wanted to say that just in case someone was like, well, you forgot to mention that Michael Burry's invested in this company. Well, yes, okay, he is. All right, but what makes GPN unique? And this is actually what they're saying, okay? They're saying their software-driven approach, full e-com, omni-channel approach, and faster growth markets. Basically, let's break this down, okay? So they like to kind of spread their roots everywhere. And you can see this with their AWS partnership, their Google partnership, their PayPal partnership. They partner with pretty much everyone. They try to just make it really easy for you to integrate them. Actually, a lot of services, a lot of customers and clients where I work with, their clients, they use this company, by the way. And when I kind of engaged with them, okay, why do you use this company? Well, they use it because it's so simple to kind of integrate within their own solutions. Okay, so that's mainly all the feedback I got. That's anecdotal. That should not be considered research in and of itself. Okay, now, again, full e-com omni-channel. Basically, they allow you to breaking that down, they allow you to do it however way you want. You want the device, you want you to use your phone, you want to use whatever it is you want to do, they got you, right? They can do anything that you want to do. And then this is the last part that I actually really like is faster growth markets. So I often say on Capital Mindset that you want to be careful with the thought that I want to get exposure to foreign markets, so I need to buy foreign stocks. Not necessarily true. The American economy, the American ecosystem, and by the way, in some European countries, some of them, not all of them, produce fantastic businesses. Even Canada, by the way, too. I don't want to leave out Canada. And the UK, okay? There are some countries in this world that produce such fantastic businesses that they expand everywhere, in every country, and they're better than all the solutions in those other countries. So you can kind of get a feel for what these companies are. You look in your home country, try to see if you have this multinational company that has proven successful track record in many countries across the world. Well, that is a company that you could invest in, and are you technically not diversifying away because it's headquartered in your country? I wouldn't say that, right? So if, let's say I invested in a company like Nestle, right? Is Nestle a Swiss company? Yes, it is. But is it giving me only exposure to Switzerland? No, it's not. So people don't have a problem realizing that. But when they look at a company, let's say hypothetically like Google or Apple, right? They think American company. I buy this thing and I have exposure to the American economy. No, you have exposure to the global economy. It's a global business, right? It's no longer really an American company. It's a global company. Well, GPN is a global company. It's one of these that I'm going to consider a global company. And they service all around the world. So they're not strictly an American company. They're headquartered here. And I won't spend too much time on that. But yes, I like that part of the business a lot. They are kind of entrenching themselves everywhere. And again, they're making themselves easier and easier and easier to use. Lots and lots of partnerships. You may be interacting with their services on a daily basis and you really have no idea, which is the beautiful part, actually. So you might know, for example, if you're interacting with Square because they have their logo on the things, or maybe even the Clover, which would be Fiserv, for an example. All right, so this is their part where they're saying, okay, innovation that delivers, right? This is the part where I was saying the merchant solutions is a huge piece of the pie. You can see right there, 66%. The issuer solutions is 23%. The business and consumer solutions is 11%. So which one is the most important? Well, the merchant solutions, and that's what they're really working on, really developing. Issuer solutions, remember, that's going to grow at the mid-single digits. Business and consumer solutions is going to grow modestly as well, hopefully a lot more. But merchant solutions is going to be the most meaningful form of driving for growth, okay? So kind of moving on, this is the part where they have a B2B strategy. You see, B2B strategy is where they're actually trying to go. So they have all of this, right? They have all of this, but they have the B2B kind of push, okay? Like I said, you might be interacting with them, but you don't know. You have no idea. You're paying for a product, and you don't know that they're using global payments. You have no idea, okay? And kind of expanding on this, the TAM, I don't like sometimes when companies use this, but I do agree with this kind of form of TAM addressment, because when they are making it easier and easier and easier for merchants to enact business, right, they take a small piece of the pie. And as long as they can take a small piece of the massive pie, that is a lot of potential for this company. Now, I think it's misleading, okay? So and I'm going to call them out on this. I'm not saying they're doing this on purpose. I'm sure this came with commentary, but I want to make sure that you, the viewer, does not think they have a potential to generate $155 trillion in revenue. No, that's the amount of money that can move through their system, okay? So what they want to do is they believe they can hit 125 trillion, right? And that's what they're saying with the B2B. Global B2B payments volume, that's what the max potential is. So that's the money that moves through their system, and they take a small cut of that, okay? And again, no credit risk, so I like that. Now, we're going to kind of skip over some of this stuff and get to the good stuff. So I probably want to highlight this. I mentioned it before, but here you kind of get like a little slide here talking about it. But the unique, distinct collaboration with AWS and Google. So yes, they are making these unique collaborations with these various companies. There is also, they made one with PayPal, by the way. So I just want to also, I haven't found one yet on that, but here's one with AWS and Google. You can kind of pause here and just read through it. I won't really spend too much time here. I think this slide gives you a better idea as to what it is you're kind of looking at. So this is what I was talking about when they have everything available for you. If you're at a restaurant, you're at a retail, you kind of get the full suite, right? You can do all of these things, right? There's even more that will actually come out over time, but they basically want to make it as easy as possible for you to collect money. And I think this graphic is decent at that. All right, they're really hammering home this whole AWS and Google partnership, so I guess I'm going to talk about it a little bit more. But you can kind of see how my portfolio is and has been. Well, you guys haven't seen when it was a lot of Amazon, because you're seeing Amazon at a trimmed position. But if only you guys knew. So my portfolio has been for quite some time heavily exposed to the cloud, right? So the cloud, and with multiple players. I wasn't actually just picking only one. I remember that I've hinted at the fact that I have a very intimate relationship with AWS, and that's all I'll say. But Amazon and Google, I think they are producing some of the best value in the entire world, and their business with regarding the cloud is by far, in my opinion, one of the best businesses in the world, right? So them piggybacking, I'm only kind of just getting further exposure to that same kind of market, and then kind of Meta is a separate one, but we're not getting into that. So they're just kind of hyping up that, yeah, they have exclusive partnerships with Google and AWS. Of course, they're going to hype that up. I mean, it is a good thing, but I think that they're kind of going a little over the top, saying that, this is amazing. But it is very good. So this is the final graphic that I wanted to share with everyone, and that's kind of the technology-enabled solutions that they're kind of shifting over to. They are moving from 40% and a target on the next cycle to 75%. You can see through 2020, it actually increased to 60%. So just in 3 years, a 20% boost, on top of the fact that they were already growing. So you got to keep that in mind. So the growth in terms of technology-enabled solutions has been a lot faster. Now, in the next cycle, they do expect that shift to continue. I do expect that shift to continue. I expect it to actually accelerate, maybe even more than what they're saying. But there will always be room for the physical and not necessarily the technological solution. So that will still be a good piece of the pie. However, overall, I think that, I like the position that this business is setting themselves up for. Now, remember that PE, we're going to kind of get into the discussion about that. So with this slide deck, I just wanted to highlight some of the things that they wanted you guys to pay attention to. And I wanted to make sure that, I didn't allow the hype of Google and AWS to really, cloud everything. I like that they're partnered with them, but, to summarize, it's not going to make or break the company. It's going to help the company a lot if they can execute well. Okay, that is the true. And they are among, from what I've been seeing, the best at what they do. Okay, so let's discuss a little bit about them. So just to highlight this real quick, do you see this line item called goodwill? So those of you who are accounts are going to be like, oh, this again. Okay, but those of you who aren't accounts, this is a line item that you add to when you purchase or do acquisitions, and you pay above the quote unquote fair value for that acquisition. So you record that as a line item, as an asset into goodwill. Now, goodwill, just to be very clear also, if you kind of study the history of fraud, has a high propensity for fraud. Now, that doesn't mean that all goodwill transactions are fraudulent. It just means that goodwill has the highest propensity of some of these line items to have fraud committed within them. All right. But again, it's completely normal. Well, we notice that it is quite high. Now, from that, I actually want to show you guys, why does that matter, okay? And here, the statement of cash flows will be a fantastic way for us to actually visualize the effects it has. So take a look at that net income. That net income line item has about $987 million for the year of 2021, okay? But take a look at the cash flows provided by operating activities. So that one is about $2.7 billion. And I'll highlight there for you guys so you guys can see it there. So $2.7 billion. How did we go from $987 million to $2.7 billion? Well, if you kind of gaze through the line items that we're seeing right there, we do see some interesting extra line items, such as amortization of acquired intangibles, okay? So this is a cost to the company, but it's a book cost. It's not really a cash cost, it's a book cost. And it's done so to kind of record the depreciation. Well, technically it's the amortization, but let's use the word depreciation because some people can kind of feel for that. When you buy a real estate property, you can depreciate it over a certain time period. So you can depreciate this intangible, and we call that amortization, over a period of time. And here in 2021, they amortized about $1.2 billion. Now, this isn't actually a cost. This is coming from the acquirements that they did from all these companies that they've been acquiring over periods of time, right? So they're just amortizing those assets and kind of over time reducing the quote unquote value of it. Now, that's not necessarily translatable into something that, like cash, right? In terms of cash, they produce a whopping amount of cash. Now, also, one thing I want to highlight is they did have from investing activities, they had a negative cash flow from business combinations and other acquisitions, net of cash acquired. So we want to highlight that, but that's not going to be normal every time. So with this, we want to say net cash provided by operating activities, 2.7 billion. What you don't see a lot of is CapEx. CapEx is very tamed. You see that CapEx is about 493 million. The previous year, 436 million. The year before that, 307 million. So it's pretty tame there. That makes sense because if you think about it, well, what are they spending really that money on, right? Not crazy amounts of equipment really necessary for this company. So if we actually look at the cash flows, they have over $2 billion in free cash flow generated in 2021. But if you just look at the PE, right, or the net income in this instance, you'd think, wow, this company's crazy overvalued. But if you don't look at the cash produced, well, then, you're going to miss out on something. So that's something to highlight. And I kind of want to segue from that and say, well, okay, PE ratios are very useful. They're kind of used as a smell test of sorts, right? But sometimes, depending on the business, you want to actually investigate further, right? Well, I would say I encourage everyone to always investigate further. Always investigate further. More investigation, the better. But some companies are, it depends. And actually, I should be careful how I say that because I don't want to provide false information. But regarding when you're looking at a business, it's very nuanced. And that's, again, the message of capital mindset. Investing is very nuanced. So it really does depend. And that's when you start to realize, okay, investing isn't that easy, right? Because every company can vary in terms of analysis versus the previous company. Just because they're part of the same sector doesn't even mean that they can be analyzed the exact same way, because there can be some slight deviation in terms of how the business kind of operates. Of course, you kind of operate under the same core principles. I don't want to pretend like, oh, we just throw out, the basic principles of how a company makes money over time. No. That's not what I'm saying. It's how the business kind of executes different transactions can affect how some of the financial statements look in a given time period. And then as a investor, as a professional, you have to kind of weed through that and understand the nuances of that, and then kind of from there extrapolate a story. So that's why I like to say accounting is kind of the formulation of these statements, right? And then finance is a very broad term, but a good person who kind of understands finance, and accountants too, by the way, but kind of like separating the two academically. Finance is kind of understanding the story behind them, right? What is going on there? Tell me a story. And if you can read a story from that and extrapolate that story, and then from there provide actionable responses to that story, then you got something going for you, right? So it's really good if you are an accountant and finance, I believe. I mean, I'm biased there because they're both, but I think that the story here is quite interesting for this company when you kind of take out the full picture, okay? Now, we'll talk about the risks towards the end because I don't want to sound like I'm just fluffing it up. Now we're going to go to the evaluation process, and I'll actually discuss some of the growth measures I saw from not only myself, but from what different analysts have been saying, and then we'll see how that kind of translates into the company, okay? So I'll take you guys to the model now. All right, so I've taken us over to the model. I already zoomed it in for those of you who are watching via mobile, but just to be clear, let's plug it in and let's see what else the model can kind of pull up for us. Okay, so right here, we're waking it up. So sometimes when I have to wake it up, it's a little bit slower. Okay, there we go. It's pretty fast today. You're showing off. So it's a strong buy rating by analysts, implying a 20.19% upside based off of a price target of 154.12. Just on that, it's a buy. Just kidding. All right, so what I've found, all right, is based off of the growth rates, right, that both analysts and I have come up with. I think that the possibility ranges between 22 on the higher end and about 12% on the lower end, more ranging in the 19, 17, and 16%. Okay, so we're going to use those growth rates and kind of figure out what price is it interesting, okay? And just kind of on a look here, we do see that the estimates are actually coming down for revenue. Okay, that's according to these analysts. And then cash flows are actually expected to rise. Okay, so cash flows are expected to rise. Sales are expected to kind of decline back to 2020's levels. That's probably indicative of one of the risks I'm going to talk about because that's what the model's probably pulling in through. Shares outstanding have been rising, but I'm going to add the caveat here of acquisitions. So they've been acquiring companies, and from what I've witnessed, they have been actually accretive. So in terms of what I mean by that is the cost of the shares that they use to acquire other companies has brought in more cash flows than the actual yield cost of those shares. Okay, so when we talk about earnings yield, we're talking about cash flow yield on the shares used to acquire a business. The cash flow yield on those other shares acquired is greater than the cash flow yield of the shares given. Okay, so it's been accretive overall, and that's something I want to say as a positive in terms of that. That's actually what I looked for as a smell test for the management's ability to actually acquire the business or good business over time. And like I said, they are a serial acquirer. Now, sentiment score is actually coming out positive, which is interesting. So that will actually take a look to see how many mentions are actually happening. Okay, barely any mentions, so we can't really kind of gauge from that. Well, actually, I don't know how many are pulled in the general, but on Reddit and StockTwits, it's only like 3 mentions. So I'm going to kind of go, yeah, maybe. And it looks like the StockTwits ones, they're canceling each other out because we get a sentiment score of about 0, or the model's actually having a difficult time kind of ranking what it is that if they're positive or negative. Now, we do see some interesting articles. Okay, Zacks Investments, Seeking Alpha. So not many new articles. The last one was posted on, well, one was posted today, but then the one before that was posted on the 24th, and then another one on the 24th. So that one, both on Seeking Alpha. So we got Seeking Alpha activity going on there. So let's take a look at some of these ratios for these evaluations, and we'll see kind of if they've been improving. Let's actually remove the noise. We don't need to see 10 years from now. All right, so liquidity ratios look pretty good, nothing crazy. Current ratios above 1, that's what we want to see. Solvency ratios, improvement. Look at that, improvement. It's gotten better. So like I said, I am liking this management team, though, so far. They actually are improving the business. From 2017 to 2021, we see broad improvement across the board. The only one that I want to see is, well, actually, no, literally across the board, much better. Even interest coverage ratios is better. So now on the DuPont analysis, we are seeing kind of improvement on the gross margins, decline from 2018, so highlight that, but from 2017, still an improvement. Operating margins, also improvement from 2017. Net profit, and remember, we're coming out of a turbulent time period, so I actually want to highlight that. And relative to 2018, actually, it's stable. So it's actually really good. Those are improving. Net profit margins, relatively stable. Return on assets, return on equity, relatively stable. I want to highlight the fact that, remember the accounting we just went over, the net income is actually showing up as worse than potentially what it really is. And on a free cash flow margin, we are seeing strong free cash flow margins more recently, about 26, 25%, 22% on the low end. 2017, it was really low at 8%. But earnings quality is good every single year measured. And if we kind of, let's actually see the full time. Okay, yeah, no, it's like it's every single year is really good. They have blips in 2014 and 2011. Okay, so every other year, its earnings quality is measured out pretty well. All right, I like that. All right, so going back here, let's actually remember the growth rates that we're kind of pulling in through. I think that on the higher end, we're going to see a 22%. And if you see right there, 22%, if that were to occur, this company is already in the buy range, okay? Now, let's go with a more probabilistic. This is actually what a lot of analysts have a consensus of, about 19-ish%. And if that's the case right there, I'm going to be getting a little bit more conservative with some of my measures. And by the way, again, like I'm not actually including a buyback. I'm saying they're not going to do buyback, and they're not going to dilute, okay? If they do dilute, so far what they've been doing with the dilution is acquiring other companies at an accretive measure. So it actually would boost some of these growth measures that I have included. So it should kind of even out as long as they're doing accretive acquisitions. If they're doing dilutive acquisitions, not good. If they're just diluting just to pay employees and just stay stagnant, that's not good. So as long as it's accretive acquisitions, we can actually experience growth rates on top of what we're kind of projecting here. Okay, so on the kind of the mid ranges, I would say 17, and then let's kind of get a little bit more aggressive on the 15, and then on the lower end, let's say 10%. So you see, if I assume a 10% growth rate going forward, that's not going to be good. Okay, so then we're not at the buy range just yet. But 10% is, I haven't found an analyst that believes that. Okay, so I don't even believe that. When I was looking at the total addressable market, well, not necessarily the total addressable market. In my mind, I'm thinking like, yeah, the total addressable market's kind of like a crazy way of doing analysis. And I was like, just said it. But regardless, looking at kind of all the opportunities they have available to them, I don't think that 10% is something in the cards. Of course, it could be. And you can see that the model is actually telling me that I overweighted it, right? Because based off of all these assumptions, and I used a equal weighting scenario here, it's saying, put 2.99%. So I currently have it at 7.5-ish%. But again, like I said, this is a tool for me. I don't follow this 100% all the time, right? And if these were the true growth rates that I think that are possible, the model's saying I put way too much money into it. Okay, we'll find out, by the way. This will be kind of an experiment. The art side of the mind versus the analytical side of the mind, who would be correct? Should this have been a 2.99% allocation? We'll find out, okay? But let's see what happens, for example, if we increase that margin of safety. And if we increase that margin of safety, I just want to highlight that right now we are in the higher scenario, right? We are in the range of 19 to 22%. That is where we'd have to assume the growth rate of this company will be in order to have a successful trade. But we have a huge margin of safety. I just want to highlight that. So we do have a big margin of safety in those scenarios playing out forward. So with that being said, I think all this culminates into me having a decision that I'm acquiring this company. Okay, so I'm on the record. I'm acquiring Global Payments, and I will always update. And if I ever decide to sell for whatever reason, it will be talked about in a live stream or in its own video. But I don't see why I would be selling anytime soon. If the position actually comes down more, I'm actually excited to acquire more because I still have some capital coming in. And again, I want to be a little bit more aggressive now than before. I'm getting more and more excited. There's other positions that I am acquiring as well. Look out for the other video on Leggett & Platt that I'm going to be producing hopefully this week, kind of discussing the same kind of concepts, why it is that I decided to acquire that company. There is a company that I'm asking permission if I can talk about it. Well, I would talk about it anyway, but I want to let everyone know if this is a company I can say that my workplace is acquiring or has been acquiring. Actually, we just kind of stopped because of an event that happened yesterday. But I really would like to talk about it with you guys because I think it's a good case study. So let me know down in the comment section below if you made it to the end of this video, if that is a video you'd be interested in doing. I don't have permission exactly yet, but I'm trying to get permission for that. All right. But on that note, guys, thank you guys so much for watching, and I'll see you guys in the next one. Bye.